For our next episode of Durable Value Podcast, we're going to be taking from the recording where I was a guest on the Next Gen Capital Conversations podcast with Heather Fernstrom and Jeff Dohrmann, IREI, and Alliance Global Advisors. Enjoy.
Welcome, everybody, to today's edition of Next Gen Capital Conversations. I'm Jeff Dohrmann with Institutional Real Estate, and today we're going to focus on a topic that resonates, I think, with so many real estate managers. Understand what it takes truly to take the next step as an emerging manager. Because either you are one or you were one. So I think you can all relate. The process can be exciting, but also pretty complex. And the path isn't always obvious, and the expectations aren't always clear. So our goal today is to help unpack what that journey looks like. And to help us walk through it, I'm joined today by Heather Fernstrom, who is the co-founder and managing partner of Alliance Global Advisors. Heather and her team have been doing this now for about 6 years, helping emerging managers and established managers develop strategic growth solutions for their platforms. Everything from organizational design to messaging governance to investor communications, marketing, messaging, and capital formation strategy. They leave anything out, Heather, or I get it all?
I think you covered it. It's always ongoing, Jeff.
Yeah. Of course, because you're growing as an organization as your clients grow. And we're also joined today by one of our clients, Ryan Suela, who is the co-founder and co-CEO of Graceada Partners, or Graceada. I never pronounce it right. You can pronounce it right, Ryan. It's a
Graceada, no
real estate investor, probably the only investment manager headquartered in Modesto, California, focused on apartments and industrial parks and secondary and tertiary markets of the Western U.S. Graceada was one of the Alliance's very first clients, and Ryan has deep firsthand experience navigating the institutional process and building the infrastructure needed to scale a business. So let's get into it. So Heather, let me start with you. Yeah, you work with dozens of emerging managers. What typically triggers a team to reach out and say, okay, we really need some help on institutionalizing our platform?
Yeah, great question, Jeff. I'd say there's always some type of inflection point. So it's fairly typical for an operator or a deal-by-deal manager to be contemplating entering the institutional space. Maybe they had some success raising high net worth, family office capital. They're thinking about some succession, planning. They're undergoing long-term organization goals and trying to formulate their business plans. And at times, the executive team can, need to come to some realization of what's next. And during that process, the executive team is, essentially toying back and forth on what's due next, reflecting on, how they've gotten to where they are today, and thinking about what is it really going to take to grow their organization to the next level. That typically involves some type of capital. And when it comes to establishing the next round of capital, that's a really strong entry point for Alliance Global Advisors to get involved.
I think it's probably safe to say that most operators feel like, life would be so much easier if they were an investment manager. What you don't know sometimes can really hurt you. But, some managers are ready, some aren't. What defines institutional readiness for an operator? How do they know when it's time to move in that direction? And what are the must-haves that a manager has to have and that, an operator who's thinking of moving in the direction might underestimate?
Yeah, a loaded question. I would say it's not a one-size-fits-all approach, but I think the biggest piece where we've seen managers fail, and that is where you don't have the entire executive team moving in one direction. And so at the onside of Alliance, conversation with the manager, we spend a lot of time with the executive management team trying to stabilize their kind of internal Q&As. And so that we get the management team all moving in the same direction, that they all have confidence that this is where they want to go. Once there's a definite, decision point of, yes, we'd like to find a way to filter in some institutional capital, we'd like to go after that marketplace, then there's a variety of steps, which we kind of call the pathway to fundraising. And within that, I would say that there's some key themes in the emerging manager space right now. The investors used to be like solely focused on track record and hyper focused on track record. And I would say in the emerging manager space, that's moved a little bit. Whereas, clearly the investors are hyper focused on track record. However, they're very much focused on the organizational stability of the platform today. And so if a manager can go in and showcase that stability, if they can showcase their investment strategy in a very clear, concise way and show the scalability of that platform, and then be able to articulate how in which they can be flexible within the investor's needs, requests, that's kind of, I would say, like the opening of it all. And we can get into more detail during this conversation.
Where do managers typically misjudge? What do they underestimate most?
Yeah, and I would love for, Ryan's feedback here too, but I would say the misjudge really comes into the intense amount of time and resource it's going to take to get ready. So I spoke about, the intensity and the prolongedness sometimes that these executive teams take in order to make the decision to finally enter or to go after that marketplace. When they do, there's a ton of kind of operational due diligence that needs to have a lot of time and attention. And what we've seen at times is that they say, okay, yes, we're ready. We start working through the DDQs. We start working through all the operational due diligence kind of responses, if you will. We start loading up the data room, start organizing everything. And a lot of the times the information is just, inconsistent in nature, telling 5 different stories. The track record says one thing, but the strategy says another. The operational kind of day-to-day way in which the organization moves is not clearly articulated in any of the operational docs. And so it takes a lot of time to almost undo it all to then redo it in a consistent format. And I would say that's where kind of managers tend to think, okay, that's just an easy check the box, upload the data room and off we go. And unfortunately, that takes months and months of overhaul. And I'm sure Ryan has some feedback there too.
Yeah, we recently spoke at the Real Estate Emerging Manager Conference in Austin, and I echoed this same thing that from our perspective, a manager should be expecting to spend $2 to $3 million over a 3 to 5 year process. And that sounds huge. But when we look back at the amount of resource and energy that was invested in that process, it's substantial. And managers get this idea that, okay, hey, I'm ready for institutional capital. That's where I need to go next. We're ready for it. And they think that they can just go out and buy it or press a button and all of a sudden, it comes, and they don't realize that it is a huge process. When we started, I joke, we didn't know what a DDQ was. We didn't have a chief compliance officer. We weren't SEC registered. If you asked me what GRESB stood for, I wouldn't know. And that's the kind of thing that you can't simply flip a switch or press a button. It's a lot of time and resource, and it has to start from the leadership level all the way down through the organization. It's not just something, you as the owner, co-founder, whatever, can outsource to someone in the organization and say, hey, go do whatever we need to do to make us institutional. It's a serious effort.
The other piece I'll add is that as you're going through this process, I've found that managers don't focus on the importance of educating their teams on the why and the how. So, for example, if say we have a 50-page, blank page DDQ that you're passing through the organization to try to get some feedback, and you're passing it to the asset managers, you're passing it to the accounting group, and you're passing it on to each of these verticals. Without the education from above, and to Ryan's point, without the direction from the executive team and the top level leadership team, these team members internally have no idea why they're actually putting this information together or how the information is being used. And they see the stress on the organization, they see the stress on the resources in order to conduct all this information and get it out there. But I think the importance of education is something that is also kind of not top level, if you will. And so at Alliance, we spend a lot of time with our managers, and we try to silo each of the verticals internally and perform these educational forums on why we're gathering this information, what we're doing with this information. Once the information is going to be all processed together, then what's going to happen with the information on an external basis, and how is it going to be used for those investors and consultants to make decisions?
Yeah, you mentioned the term DDQ and that you didn't know what it meant. And there may be people tuning in that don't know what it means. It's due diligence questionnaire for those of you who aren't familiar with the term. So Ryan, as I understand it, you were on Fund One, you'd finished Fund One, and then you're getting ready to do your second discretionary fund, and all of a sudden decided maybe we need some help. What led to that decision?
Yeah, great question. So at that point, we were already a very seasoned operator and manager. We had been managing discretionary capital, but it was high net worth family office. We came from a third-party property and asset management background. So I'd say from an operator standpoint, our organization was very mature, very sophisticated. But what we realized is the strategy, so we focus on secondary and tertiary markets in the Western US. We focus on apartments and multi-tenant industrial. And this is a large untapped opportunity in our minds. And the data shows this, these are markets that are broadly non-institutional. And it's no coincidence we're based in Modesto. That is part of the, origin story, so to speak. And so what we realized is the market potential of our strategy is significant. It's probably one of the last large untapped non-institutional kind of segments of real estate. And so we realized the market potential is huge. And so that's really where we recognized we need to be going up to institutional capital, because the market opportunity that we have relative to capital is needed. And it just happened that at that time when we kind of had that epiphany, I saw Heather at a conference. Actually, this was during COVID. And so this was a virtual conference. I think it was May of 2020. And little did we know that Heather and Jen were just starting out their firm as well. And so we were, I think, client number 1 or 2 with them. And I do tell people, we candidly did not recognize the level of investment necessary to go through that path. And just to fast forward a little bit, today we're on Fund 4. Our biggest commitment to date, we just got a $90 million commitment from Pennsylvania state teachers. Actually, just yesterday, we found out about a very well-known name brand university endowment that is investing with us. So clearly the result has been successful, but it was a long process to get there. And I think managers need to understand that it really is a real investment of time and resource to do that.
Heather mentioned earlier that managers moving into an emerging manager focus from being an operator tend to underestimate things. So what are the things that ended up being underestimated by you when you first started out?
Yeah, I'd say the 3 main areas that Alliance helped us. The biggest one really is what I would call institutionalization of the organization. So this is really not about writing a policy and putting it on the wall. It's not about creating a document and then, filing it away. This is about making sure that all of the internal processes of the organization are institutional, from finance and accounting to investment committee to asset management to acquisitions. Everything about how you do things is institutional. And that, I would say, was the biggest lift, without a doubt, is really kind of like Heather alluded to. inculcating within the whole organization, all the way down. We're vertically integrated, so we have a team of about 75 people. And so this means all the way down to the property level, down to the property manager level, making sure that they understand how we do things in an institutional manner. That was the biggest. The other two areas I would say were helping to better articulate our strategy and communicate in a compelling way to the institutional community. Because as I think we all know who've been doing this for a little while, the institutional community has a different lens with which they're looking through things than a high net worth or a family office. It's different based on, the type of institution they are, how they manage money, what is important from a risk and a return standpoint, and being able to articulate that well, and what our unique approach is to institutional community. And then the last part of it is really kind of understanding the landscape of the institutional community and how to access, institutional investors. But definitely the biggest one was that kind of changing the organization, the fabric of the organization.
And what impacted those shifts that you made as a result of the advice that Alliance provided? What impact did that have on how investors perceive the firm, do you think?
Well, I would say it this way. First of all, it's definitely somewhat of a black box. When you're working with institutional investors, you don't always get constructive feedback. A lot of times you outreach, you don't know why it is or what it is that they like or don't like about your strategy. But what I would say is when we've received that feedback, like for instance, we went through the IDD, which is investment due diligence, and ODD, which is operational due diligence. When we went through the IDD and ODD process with any PC, for instance, a lot of the feedback that we got back was, you guys punch above your weight, or you guys are more institutional than we would have expected for a firm your size. Similarly, when we went through with Axia as well. So I'd say that is probably the best measure, is just that when they do that deep dive and they dig down into your organization, because as Heather said, part of the DDQ process and part of asking a lot of questions is understanding if what you're saying you do is actually what you do, and if what you're saying you are is actually who you are. And so they are looking in many ways for internal inconsistencies. And if the organization as a whole doesn't consistently reflect what you actually say you are and what you do, they're going to find that out. And I think that's an important part of that process, is really unifying how you do things and how you articulate who you are.
So if you could give one piece of advice to somebody out there listening in who might be an operator thinking about moving into emerging manager space, or maybe already is an emerging manager, just starting the journey, what would that advice be?
Well, first I would start with what you have. So every emerging manager should recognize that you have a unique value proposition. You should be generating alpha above the market. That's the reason people are drawn to emerging managers, is because they have the ability to generate outsized returns relative to the real estate market. Otherwise, they shouldn't be investing with you. They should invest with, some name brands I won't mention. We went through the PCERS process, Pennsylvania PCERS, and as a part of that, they had to benchmark our realized and unrealized track record against their benchmark. And it showed that we generate, across all of our realized and unrealized track record, 752 basis points of alpha. So 750 basis points, 52 basis points above the market. This is why institutional investors want to invest with emerging managers, because they get that alpha. So I would start by saying, recognize that you do have something unique. You do have a unique value to offer. You need to know how to articulate that, and you need to be prepared for a big process. That's really what you have to ask yourself is, am I prepared to spend $2 or $3 million and 3 to 5 years really changing the nature of the organization to be able to handle institutional capital? And you have to understand that while they are looking to the emerging manager for alpha generation, their biggest filter or their first filter of any investment is risk mitigation, because they are entrusted by the retirees, by the university endowment, by whoever it is. They're entrusted to steward those funds. And so the first lens is risk mitigation. The second lens is investment performance. So recognizing that going into the process, it helps to understand why there is this magnitude of investment. But go in knowing that you do offer something unique to the world, but it's going to be a big investment if it's something that you're committed to.
So Heather, you just heard what Ryan's been talking about, and you not only heard it, you probably lived it with him. What parts of that story do you really see all the time with clients and prospective clients?
Yeah, I would say that one of the main parts that I've seen consistently is that there's these executive teams of these emerging managers that are making a lot of assumptions or not quite putting in the time to understand the process between the investors and the consultants and how these decisions are being made, the investment committee process, the reporting process, the underwriting process. And so I would say that one of the areas that I would focus on if I was emerging manager is really studying the market and identifying the relationships between the consultants and the investors. When you're in a meeting and you're able to be in the presence of an investor or a consultant, make sure that you're listening more than you're speaking. There's a lot that you can learn in these meetings. There's a lot that you can learn and do some homework prior to going into these meetings. Many of these investors, their reporting is public information. And so with just a little bit of digging, you can start to understand how they're thinking about their overall portfolio construction. And if you know their portfolio construction and you understand their underwriting process and you understand their decision-making process, you should be able to go in these meetings and really articulate your differentiators, the way in which your investment strategy could, ultimately be a differentiator for their current portfolio or some other opportunities that they're looking for in the current marketplace.
And what would you say are the biggest three gaps that you typically find when you're looking at one of these firms?
Yeah, the inconsistency in messaging. So I would say that's in materials and then also just in conversation. So you could get three co-founders of an organization and they'll all speak the history of the organization in a very different manner, right? They'll speak it from their own personal experience versus, a concise, organized message that resonates, throughout the entire firm. Ryan spoke to some of the operational inconsistencies and like how are we really doing it on a day-to-day and actually how we are doing it, is it clearly articulated in the materials? Because as you're going into these meetings, the investors are going to dig, they're going to ask questions. They're going to have spent some time in your ODD and DDQs beforehand. And they're going to be in listening mode themselves. So if what you're speaking to is different than what's on paper, that's an automatic, no, thank you, and moving on. And then the other piece I would say, like the third one would be the inconsistency in track record versus going out to the market for investment strategy. So it's really important that your track record showcases that you have the ability to be successful in the investment strategy that you're bringing to market. And the other piece to this is that you want to be able to showcase that your current investment strategy has some scalability into it. As these investors are looking to understand and get to know these emerging managers, it's not a one-time transactional relationship that they're looking to adopt with these managers. They're looking for longevity in their relationship. So they want to know that their platform is scalable and that investment strategy is scalable as well.
So Ryan, there's at any given time about 1,200 of these investment programs in the market competing for investors' time and attention, and they're overwhelmed. They can't respond to everybody. There's no way, and they admit this in public all the time. How do you stand out? How does an emerging manager get noticed? How do you stand out and really get the time and attention of these guys when so many people are knocking on their door and asking for their time and attention?
Yeah, I'd say for us at least, we invest in secondary and tertiary markets. I love saying that word. To some investors, that's like a four-letter word. Whoa, that means risk. Hold on. And what we learned early on is we have to hit the misconceptions about the market at the front end. Because there are misconceptions around liquidity, around economic vibrance, around how real estate performs during downturns. And so we spent time doing the research and providing the data that shows actually if you're in the right asset size, that's the most liquid part of the market is the smaller asset size, not the larger asset size. Showing that GDP growth is stronger in secondary, tertiary markets. Population growth is stronger. It's less volatile than it is in primary markets. A lot of these preconceived notions really needed data to show that no, actually, these are highly investable markets. They're just overlooked. And so I would say that number one, take whatever strategy that you have and really put flesh to it from an institutional investor perspective. Help them understand why your strategy is compelling and why they should be looking at you, whether that's through research or better articulating what you do that is unique and why. And then the second thing to that is, as Heather said, listen. We do a good job of going in and talking about what we do and how great we are at what we do. But if we're not listening to the investor, we're not receiving back information that's important for what we do. And that's another thing that because our strategy is so unique, it's obviously a high return generating strategy. It has low risk characteristics, but it's unique, and it's not for every investor. And so what we've learned over time is that we need to listen and make the conversation short if it's clear that that investor is not a good fit for what we do, or that what they're looking for is not what we are able to provide. And don't try and sell, but rather listen and find those investors that are naturally drawn to the strategy.
Okay, so it sounds like you've successfully made the transition to an institutional platform. What's next? What's the next step for the firm?
Thank you. Yes, I'd say especially with our Fund 4 momentum, we've been very fortunate. This fund will be 80% institutional capital, pensions, and endowments. And more importantly, what I would like to say is those early investors that invested with us, they mean the world to us. These are the early investors like Pennsylvania Piecers that really took the bet and they said, I believe that you have the ability to generate outsized returns. And so we will forever be grateful to those groups, and we hope to have a long, decade plus relationship with them. But I would say when we look for what we see in the future, we do believe that this market is one of the last large untapped non-institutional markets. So we think there's tremendous opportunity. And I like to say that we would like to be known as the Kleenex brand, the brand name associated with secondary and tertiary markets in the West. So when people say, hey, I actually think I want to get involved in these kind of markets, that the name Graceada, and feel free to call it Graceada, by the way, the name Graceada is associated with these markets.
Okay, well, that's been a great conversation. Thanks, Ryan, and thanks, Heather. Hopefully for those operators who would like to be emerging managers and the emerging managers listening in, you learn some things along the way. And here's the real takeaway. Institutional success doesn't start with capital, and it doesn't start with deals. It starts with readiness. And if your strategy is strong, but your platform isn't yet built to inspire confidence, now is the time to start investing in structure, narrative, and alignment. Companies like Alliance Global Advisors can help companies like yours build the foundation you need to scale, and they can help you understand exactly where your platform stands and what steps will move it forward. Bottom line is, you don't have to do this alone. and you don't have to struggle, and you have to spend years making mistakes. You can get help. It's out there. Alliance isn't the only one that does this, but they certainly are available to help you. And if you need help, don't be bashful to ask for it. Give Heather and her team a call and explore ways that they might be able to leverage what you're trying to accomplish. Again, thanks for listening in. Thanks, Heather. Thanks, Ryan. And looking forward to our next conversation.
Thank you.